Hello and welcome to another in the Alphi educational video series. And I'm very proud today to introduce a special guest, Steve Blackwell of Invito Energy.
Thank you for having me. Excited to be here, buddy.
Yeah, you are the CEO of Invito.
I am CEO, co-founder. I have a partner, Jared Christensen. So
I met him. We went out to New Mexico together, right?
Yeah. So we co-founded.
And he's like your lead engineer?
Yeah, he's on the technical side of the business.
Awesome. Awesome. So the point of what today is just to give people kind of a deep dive into oil and gas. Not really from a, I almost wore those same shoes today. It's a good thing I didn't.
Well, good minds think alike, buddy.
That's right. That's right. Not necessarily from a morality standpoint. Okay. Right. I'm a huge believer in the moral value of oil and gas. But that's really not the point of this video. The point of this video is to educate our viewers as to the tax benefits and the investment benefits of oil and gas.
Right. Okay.
Okay. Now, neither one of us are tax professionals.
Right.
Right. We're not CPAs. We're not tax attorneys.
Always put that disclaimer in there when it comes to tax.
That's right. So seek out a tax professional for your individual blah, 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 whatever. Okay. Sue me. But yeah, and a lot of times, we'll go through a script with questions and stuff like that. We're not really doing that today. I feel like the two of us have done this.
Yeah, don't need that.
Yeah, we don't really need that.
Don't need it.
So let's just get into it, right? When somebody invests in oil and gas, okay, my understanding is there's kind of like three things they get, and two of them kind of go together, right? So one is you generally get a return on your money, or you try to.
Of course, that's the number one goal.
Yeah, that should always be your number one goal with any investment,
Correct.
Right?
Yes.
And it's funny to me. I see a lot of people that, they make some investments without that being their number one goal. Don't know why.
They let the tax tail wag the dog.
Yes. But the second thing you get, and it's kind of two things: intangible drilling costs and bonus depreciation. Right? Would you lump those together? Would you separate them out?
No, I would separate them out because they are treated differently in the code, but they essentially are the upfront deductions combined, or the two upfront deductions. So the IDC is the big one, and the bonus depreciation is essentially, which is, with the big beautiful bill that just passed in July, right? Bonus depreciation is back to 100%, and so that has benefits to oil and gas, just like it does for a lot of industries. So yes, I would say that those two are lumped together because they're the upfront deductions, but obviously they're handled differently from a tax treatment standpoint.
Gotcha. So generally speaking, now also these deductions, I think hold a unique place in the world of deductions, right?
They've been around a long time, which is nice, right?
So 1916.
Yeah. So there's the I don't know the official start date, but they've been around for decades. So lots of case law. Anytime you're looking at a tax strategy, right? One of the things, at least my suggestion always is where does it stand from the IRS? In other words, every year the IRS puts out a dirty dozen list, or it'll tell you the programs or the types of strategies that they're going to look at. And the IDC deduction has been around so long, it's not on that list. It's not doesn't have hardly any significant audit risk to it. In the words of IRS, is not targeted. The easiest example to counter that would be like conservation easements. If you've ever heard about,
yes,
you've heard of conservation easements. The IRS is essentially telling you we're going to audit those programs. And so the nice part about oil and gas is that's not the case. So the audit risk is significantly lower.
Why do you think the IRS has decided to fight back? Like, this is one of the things that I always find curious, right? If something's in the tax code, it's in the tax code. But yet the IRS likes to do what you just said there. They like to make it more difficult for somebody to use, even though it's in the tax code. So why do you think the IRS is telling you ahead of time, we're going to audit everybody that does a conservation easement?
I think because there's abuse in the gray. The bottom line, right?
It's not clear enough. So here's something really important, I think, for people to understand, right? As it appears to me, the government writes a law. A lot of times it's really ambiguous. It's not very clearly defined how it impacts taxes. And then there's even things where I know people pose questions to the IRS, and the IRS says we're not going to comment on that.
Yeah.
And then they wait for somebody to do it, and then they sue them, and then it goes through the court system, and that's where the law gets clarified. Is
Correct.
that an accurate description?
And again, that's not my area of expertise, but yes, I mean, their rulings or their opinions on stuff sometimes take a while. Even some of the stuff in the big beautiful bill, right? We're waiting for final, opinions from the IRS to come out. But I think the biggest thing I would say about when you're talking about strategies that are going to show up on the watch list is one of its fairly new concept, new strategy.
Yep.
Two, it's the multiples. There's a lot of programs out there now that are offering multiples, and those are going to end up being on the IRS is going to talking about. I mean,
are you talking about like there's companies out there that will sell you shares in a company that has bought some kind of donatable asset? And I don't think donatable is a word, but
that's a charitable strategy. So that's another one, right?
Yeah, it's a charitable strategy where you buy into like rare docs, volcanic ash, magnesium.
Yes.
They've held it for over 12 months. And so you can buy into it. Usually it's a $50,000 minimum. $50,000 gets you $200,000 in a deduction.
Correct.
And I know
so that's what I mean by multiple. So conservation, same thing. You put in $1 and some easements were giving you $6, $5, $6, $7, $8 write-off.
Yeah.
Right. So multiply it out. You put in $1 million and you get a $700,000 deduction or 500, whatever it may be.
Yeah.
So that is obviously because of that big multiple, which is not how
oil and gas
works or real estate works.
Yeah.
They're gonna look into that stuff.
Gotcha.
And the abuse is typically in the valuations.
Okay.
Yeah.
So they're saying that the valuation of the asset is being inflated, creating that multiple.
In many cases.
And that's why they're auditing it and fighting against it.
Correct.
Now, when it comes to intangible drilling costs and bonus depreciation, when I make an investment into oil and gas, how does that work? How is it different?
Yeah. So the easiest analogy that most people are familiar with is real estate, right? So it's essentially depreciation. It's just called an intangible drilling IDC deduction in oil and gas. So the cost of a well to drill a well. Now, I should probably back up for the audience a little education, right? When you're investing, if you believe in the energy sector, you can buy ETFs, you can buy individual stocks, depending on what sector you believe in. But if you're going to invest directly into oil and gas, the most common way is in the upstream sector, which is the sector that drills the wells. And inside of that, you're either buying what's called working interest or what's called royalty interest or mineral interest. And so royalty or working interest is just like equity. Let's say I own this building and I own 10% of this. I'm a 10% equity owner. In oil and gas, that would be called working interest. And so when a well is drilled and you are a working interest owner and you are specifically investing that into wells that have not been drilled yet. So for example, in oil and gas, you can buy into wells that are already cash flowing. So it's just buying into a cash flowing asset.
And you're just basically buying income.
Yeah, buying income, just like any other income producing asset. And there's a whole market for that. And most people are trying to outperform the bond market when they do something like that. There are tax benefits there, but there are not the big upfront tax benefits. The IRS has specifically written sections of the code to incentivize capital to flow to the development of new hydrocarbons, discovering new hydrocarbons.
And not really to mince your words, but really wouldn't have been the IRS that wrote it. Congress wrote it.
100% correct. You're absolutely right. Yeah, wrong words. As Congress does, it uses the code.
Correct.
To incentivize capital to flow where they think it should go.
Yeah, and so this is something I push all the time. Everybody, to me, I think, views the tax code as a penalty box. But to me, the tax code is 99% just telling you, do these things and pay less taxes. And the majority of it, I would say, do these things and defer taxes.
Yes.
Some of it is do these things and pay less taxes. And then a very tiny portion of it is do these things and actually get your money back.
Yes, there's tax difference between a tax deduction and tax credit. So
yes.
Yes. Now, of course, we all know the code is about that high if you stack it up.
Yeah.
But anyways, back to oil and gas, you're correct 100%. Congress a long time ago wrote these laws in place, and through that, they're basically saying, hey, if you put capital here, which we want to incentivize money to flow into the development of hydrocarbons in the United States. The development of hydrocarbons is drilling oil and gas wells.
Yes.
And the reason why that was put in place is because the United States historically, if you really take away the last 15 years, The United States roughly consumes about 20 million barrels a day of oil. And, 20 years ago, we were producing 3 to 5 million barrels a day. We're now the largest producer in the world.
Isn't that amazing?
Amazing. The oil and gas industry has just done an amazing job over the last 15 to 20 years.
Which is wild to think that over the last 15 to 20 years, it's become a more and more hostile environment in my mind. Maybe not legislatively or anything, but the public persona, the campaign against oil and gas, the campaign against fossil fuels.
Yeah. Well, the climate catastrophe movement has come into, it's whatever you want to call it over the last 20 years, right?
Yeah.
The voices have gotten a lot louder.
Yeah.
So in spite of that, the oil and gas industry inside the United States has taken us from a mass importer of oil and gas to a net exporter and the largest producer, not only in the world, but in the history of the world, which is just unbelievable.
Yes.
So obviously, not that we're going to get into it, but what the things that are playing out in the world today, you are in a much better position.
Oh my goodness. Yes.
From a leverage standpoint. If this is 25 years ago or 20 years ago and what's going on over in the Middle East, we'd be in trouble.
Not just the Middle East, with what's going on with Russia and Ukraine and the Middle East.
Absolutely.
I mean, you're talking about two of the biggest energy producers are now at war with the free world.
Yes.
Or have been at war with the free. I mean, I believe both Russia and Iran have been at war with the free world, just because it wasn't a, boots on the ground, directly in your face acknowledged war. They've still both been at war with the free world for decades.
Yeah, not to get into the politics of it, but the only thing I would say to that is, and when people call me about it today, I'm like, look, all this is reinforcing is that energy drives the world.
Yes.
And if you're running a country, if you don't have access to energy, sustained energy, and now and into the future, your country is at risk. And so energy, for the most part, in many cases, World War II, I mean, Japan invaded the United States in large part because we blockaded their access to oil. And so you got to have access to energy. So back to where we're on, but that's why it was put in to incentivize capital to flow there, right? So when you drill a well, a brand new well, what the IRS basically said, the code tells you is there's two types of costs in a well. There's intangible drilling costs, intangible drilling costs. Intangible drilling costs, to make the definition easy, is any cost that goes into the ground to drill a well that has no salvage value once the well's done producing. Tangible would be the opposite of that. Intangibles typically make up 75 to 85% of the total cost of a well. And what the code tells you is you can take 100% of those and deduct those in the first year of investment. And so that's essentially like depreciating an asset. It's just called an intangible drilling cost, IDC deductions, 263C of the code. And so to make an easy example, if a client was putting in $100,000 into a well and the IDCs were 80%, for us, since we issue a K1, that K1 would show up on line 13 of the page one is an $80,000 loss, which flows through to your Schedule E and through to your 1040. So being above the line deduction of your adjusted gross income. What makes it so unique is this piece right here. This is a completely passive investment, meaning you are not managing, you're obviously not drilling the wells, you're not managing the partnership, right? You're not designing the well design or how to complete it or drill it, any of that. You're not managing it.
And we're not even going to let you pick the color of the well.
No, right? So you have nothing to do with it, which means it's passive, right?
Yes.
And so typically passive losses can only offset passive income.
Yes.
But there is an exception in 469 of the code on the passive active loss rules. And it's 469, which is called the at-risk rule, which allows you to take this loss and offset ordinary income. As long as you come into the fund, most of these funds are set up as limited partnerships. You come in as a general partner and you sit in the GP position while the wells are being drilled. So maybe the first 12 to 16 months. And that allows you to take that loss, the IDC deduction, and offset ordinary income. So think about it. You have a W-2 job. What can you really do to reduce your income?
You're so limited.
You're so limited, right? This is one of the very few strategies that is great for W-2 people. It's great for any type of person that has a lot of ordinary income. And so from an advisory standpoint, whether you're a CPA, tax strategist, or a wealth manager, with high net worth clients or high earning clients that are looking for tax strategies for any number of reasons. If that income is ordinary, this is a great strategy to use. So you get the big upfront IDC deduction. The remaining costs are called tangible costs: pipe, casing, production equipment, et cetera. Something that
Stuff that can be reused on another well.
yeah, something you could pull out of the well when it's done and potentially resell it. And that's 15 to 20, maybe sometimes 25%, but let's call it 15 to 20% of the cost of a well. Normally you amortize that over 7 years, but with the big beautiful bill, you can take bonus depreciation now on that as well. So you can accelerate that and take all of that either in the initial year of investment and match it up with the IDCs, or you'll take the tangible deduction through bonus depreciation the following year. The only caveat for taking bonus depreciation in the same year is whatever well you invest into has to literally be drilled and made capable of production in that same calendar year. So typically you take the bonus depreciation next year.
Gotcha.
So, but between the two of them, you're going to get, somewhere between, 95, maybe a little higher percent. Look, lease costs are the only costs that you can't write off up front.
Gotcha. So yeah, for our clients, if we're wanting to eliminate $100,000 of income, we generally do $120,000 into oil and gas just to give us that. So that in year one, we come as close to that 100,000 as possible.
Yeah. And then you'll have additional deductions the year two.
Yes.
The second year, which will either give you another loss or it'll offset the income that you get from the wells.
Yeah. And really too, I could do, before we get into that, now there was a really shitty part of the Tax Cut and Jobs Act of 2017 that came into play.
Yeah. Are you speaking about the excess business loss rule?
Yes, the business loss limitation rule.
Yeah. Mm-hmm.
And I just looked that up because it's decreasing. Last year it was $313 for an individual, $626 for a married couple.
So I think it's
in 2025 it's down to, I have it right here, $256 for a single filer and $512 for joint.
Is that for 2026 or 2025?
That's for 2026. For 2025, it was $313 and $626. Right. For 2026, it's gone down to $256 and $512.
Yeah, for single filer 256, joint filer 525. Yeah, so that's the excess business loss rules. Yes, which is 461 of the code, which you need to pay attention to.
Yes, and so back to the W-2 person, right?
Yeah.
And if they're married in 2026, they could, so generally speaking, I don't know that you would want to try and do oil and gas every year to offset your W-2 income. But what if you got a bonus, you got awarded stock that flowed through to your tax return?
I think
maybe I just had a friend, their company got bought. And as part of that company being bought, he got $400,000.
Yes.
That in equity payout.
Right.
Right. Even though he's a W-2. Right. So he could have done, and he's married, so he could have done an oil and gas investment. And he also, we should add this caveat: in order to invest in oil and gas, you have to be an accredited investor. Correct?
For most programs, there are probably programs out there that take unaccredited investors. But they all fall under what's called the 506C private placement rules, Reg D offerings. And so for us, we only take accredited investors, which, that's not a high bar anymore.
No, it's funny how that has stayed. So that's one thing I just made up a term. I call it tax code arbitrage. Yeah. It's just all these things in the tax code that got written in at one point in time for certain reasons. Those reasons are gone, or the environment's changed, or situations changed, but it's still there.
Yeah.
And so an accredited investor's definition has not changed in I don't know how long.
No, it has not.
Right. And so it's basically just if you're single, you make $200,000 for 2 years with the likelihood of making $200,000 in year 3. If you're married, it's $300,000 a year for 2 years with the likelihood of making $300,000 in year 3. Or having $1 million net worth, excluding the value of your primary residence.
Correct.
Right.
So in today's day, that's good money, but it's not that high of a bar, because the way I look at it is all alternative assets, which is what we fall into the bucket of, right? Mostly the biggest thing you're offset giving up is liquidity, right?
Yeah.
If I invest in a stock, I could sell it before the end of the day if I want. You need to get a risk premium for alts because of the liquidity. And so you don't want to be putting money into illiquid investments if you have very little liquidity. And so if you don't have those minimum income numbers or that net worth, then you probably shouldn't be investing into illiquid assets.
Yeah. Yeah. Now, I want to hit on one other thing from the business loss limitation rule. That step down stops, and now it it does increase moving forward with inflation.
Yeah. So it'll be inflation adjusted. And so the key part there is where it gets a little confusing is understanding where it hits and where it doesn't hit. So the one example is, let's say I'm a W-2 person and I have $1 million of W-2 income.
And we're married.
I can't go invest enough money into oil and gas to where I would create $1 million loss and I could wipe out all my taxable income.
Yeah. But you could do $512,000.
But I could do $512,000.
And if you think about it, that's the top 512,000.
Yeah, you're always, you want to manage tax brackets, right? That's another thing this helps you with, right? Because you go, what is it, 26? You go from 20 when the 26 bracket goes from 26 to what, 34?
The biggest jump is from 12 to 22.
Okay.
That's the only one that's 10 points.
Yeah, and then the next one is
and then it's 22 to 24. Yeah, we should. Yeah, we'll post a screenshot that shows.
I think it's the 26 tax bracket goes all the way to
35 to 37.
Yeah. So you want to manage those brackets, right? So you're not going to the top of that income. But back to the example, I'm a W-2 employee and I got $1 million. The most I can invest, take a loss, right? We're leaving the investment side out of it, but for a tax strategy would be the $512,000. Now let's take that same individual, owns their business.
Is it an S corp or C corp?
Doesn't matter.
It doesn't matter because with an S corp, right, all that income flows through to them.
Right, still business income.
Okay.
Right? So if I have business, whether I'm an S corp or C corp or whatever it may be, and my business income is $1 million, right?
Before I pay it to myself?
No, just say the taxable income that I have after I've taken all my other deductions.
Okay.
I've still got $1 million of taxable income. Technically, that person could invest enough to take that $1 million down to zero because they don't have a business loss. They still have a total business loss of actually they're breaking even.
Gotcha.
Right. If I have $1 million of business income here and I invest in another business, which is essentially what is an oil and gas investment, and it's $1 million loss, what is my total income? It's zero. I don't have a loss.
Okay, but let's just say I own a business, and we might have to edit this out. I might be setting you up. So let's say I own a business. I make $1 million.
Mm-hmm.
Okay, but I also then convert $1 million of my IRA over to a Roth.
Mm-hmm.
Now I could do, and I could do $1.5 million to wipe out the $1 million of my income and another $500,000 to eliminate $500,000 of my IRA conversion. But I could not do $2 million, wipe out my $1 million of income and the entire $1 million IRA to Roth conversion. Because these are two separate things. One is profit from the business. I can eliminate 100% of that.
Right.
But I can only go negative so far.
Correct. You're right. In your example, you're correct.
Okay.
Because you would have ended up with exceeding the excess business loss
limitation rule
of 512 because you were trying to wipe out everything.
Got you. And so this is something that we try to really match up when we're doing IRA to Roth conversions. Right. We do a lot of offsetting the tax on the IRA to Roth conversion by coordinating it with a offsetting oil and gas investment.
Yeah. And you have to look at the total tax picture, income picture when you're doing that type of planning, which of course, as you said at the beginning, it's important to have a good tax professional.
Yeah.
But yeah, those are things that you have to pay attention to.
Yeah.
As well as AMT, but AMT is something you have to pay attention to regardless. But there are special handling rules for AMT in terms of IDCs as well. So you need a good accountant for that as well.
Yes. So let's get into that because in the last 3 months, I've had 4 separate clients. 2 are business partners, so it was the same CPA. So it's 4 different clients, 3 different CPAs. A CPA in Montana, a CPA in Florida, and a CPA, I think here. I had the clients ask the CPA the exact same question. It was just quite simply, hey, I'm doing some tax planning. I'd like to know what my estimated income is because I want to do an offsetting oil and gas investment. Not a single one of these CPAs asked any clarifying questions. All three responded exactly the same, that they didn't know why they would do an oil and gas investment because it can't offset any of their income. And so I find it, and then, yeah, I love the look on your face. You should, I hope the camera gets the look on your face because that's the same look I had. And so then I had to have my clients copy me in on the email.
Right.
So, and I'll be honest, in these email interactions, I'm an asshole. Not overtly.
Right.
Okay. I want to be brought in so I can show the client how shitty their CPA is. And so I don't directly. So what I'll do is I'll ask questions to the CPA that reveal the CPA doesn't know what they're doing when it comes to oil and gas.
Right.
And so I guess that would be my question. How is it that, I mean, seriously, I've not had, those are the only 3 interactions I've had with clients who are using outside accountants. None of them are anymore, by the way. Which is the
Smart.
point, which is the point of my interaction with them. Well, how is it not a single one of them understand this or are even willing to like ask clarifying questions to make sure that they're addressing the matter correctly?
Well, one, I would say, look, this oil and gas deduction is kind of a hidden gem in the code.
Even though it's been around, I mean, I've looked this up. It didn't, I thought it had gotten put in, I thought it had actually existed. I'd read something that said it existed before the tax code. I looked it up. It actually got put in 2 years after the federal tax code was created in 1914. Yeah. It got put in 1916. This is not new.
No, it's not new, but it's very much something that is not widely known. Even inside the oil and gas industry, you would be surprised at how many people in the industry have never had no idea how this worked. And so I'm not excusing people. I'm not excusing someone, whether it's a CPA or a tax trust or an advisor, that they aren't aware of it. Where the problem comes in is what happens after that part of it. There's no excuse, especially with AI today. There's no excuse for them to not go do the homework, learn how it works.
I mean,
that's what your job is.
It has never been faster to do homework.
Even before AI, it was not excusable to go figure it out. But unfortunately, just like there are in a lot of industries, whatever profession it is, there are lazy people. They don't want to do the work, right?
Yeah.
And again, that's why there's a difference between a tax preparer and a person who does tax strategy. And most CPAs are tax preparers.
Correct.
They're not tax strategists. In other words, they're just running a machine, man. They want to kick out as many returns during tax season as possible because that's how they make their money.
Which to me sounds like an absolutely miserable business model.
Right. And so guess what? They're not going to want to go take the time when, John Smith their client John comes in and says, "Hey, what about this?" They're like, they don't want to mess with it, man. They just want to crank out returns.
Yeah, they literally just respond no.
So you've got to get
no, and that's why I call them. I call everybody's team their team of no.
Yeah,
you're gonna take something back to somebody and ask them a question. It's no.
Yeah,
that's your team of no.
Yeah, I mean, if you have a very basic filing, then that's all you need.
Yeah.
Right. But if the more money you make, the more types of investments you get in, the more strategies you're pursuing, you're going to need more professional, experienced, whether it's on the advisory side or the CPA side, and most likely on both is what you need. A good advisor who is doing the research and learning about this stuff, and then a good outside or an accounting firm that also has a person that's knows about how this stuff works, or at the very minimum, okay, let me go figure that out. I'll go do the research and I'll come back to you.
Yeah.
Right.
Yeah. So that was one area in which you really helped me out. Because now for all of our clients, how long have I known you now?
I don't know, man. It's been like 5-6 years, I think.
Yeah. And so we did little bits of oil and gas. We've really started trying to ramp that up.
Yeah.
And to help us with that, you actually connected us to your firm's CPA.
Yes.
Can we give him a shout out, David Freeze?
David Freeze, yeah.
Yeah.
I've known David a long time, over 20 years.
Yeah. And that's been incredible.
Yeah. And so he knows oil and gas inside and out. but he's also a guy who I can reach out to him on any new things that are happening in the code, and he already knows and is aware of what's happening.
Yeah.
So he keeps up big time, but he deals with a lot of higher end clients.
Yes.
So he has to be up to speed on the code and as you know, the changes of the code, which happen all the time.
Yeah.
Um, so he does a good job with that.
Yeah. And then one thing you should definitely, um, like whoever you're working with should definitely be using today, because it's never been easier. And one thing we just rolled out this year is software that we run every tax return through, and it runs it against 150 different strategies within the tax code to identify where you could be improving your or minimizing your tax liability. Like, this isn't even something you have to sit there with your little green visor and an abacus and a slide rule and try and figure out anymore. Like, software is fully capable of identifying a lot of this stuff today, right?
Correct. And of course, with the advent of AI, which is literally changing at warp speed,
Yes,
and
it
its
is.
capabilities, it's kind of astonishing.
Yeah.
It's only what would take, in the past would take make 3 to 4 years of updates and new changes. It's literally happening in months now.
Yeah.
Like, what you could do in AI 90 days ago to what you can do today it's unbelievable, the pace of change that's happening.
Yeah, well, and that's what. So last year is when I realized an idea that I'd come to you 6 years ago. I was probably going to be capable of doing, and there was two components. One of which was AI that made me believe we would be able to figure it out.
Yeah,
and it did.
Yeah,
which is what's allowed us to do a lot more oil and gas for our clients. Now I got another angle to go at you with. One of the things I always hear, and I hear all the time, is nobody ever gets their money back on an oil investment. So, and I even have a client, and I'm super confused as to why his oil and gas investment is through one of the major oil and gas funds. Because when I was looking at when he went into it, I knew you.
right.
So I can't, for the life of me, I can't figure out how he ended up there instead of with you. But what's the difference between like a U.S. Energy? Are we allowed to name them? Because they're like the biggest one, right? That people put their money into.
Yeah, and I don't want to get into name and names, but yeah, they're the largest in that space in terms of raising direct. But if you just take names out of it, here's what I would say to people to understand about oil and gas. Oil and gas is inherently a very high risk, high reward business for the people that are in the business. So the companies this is their business, that's what they're used to, that risk, and they know how to manage that risk, right? So, but if you're a retail client, right, and you're an advisor, and most retail clients, they all want to make money, right? But what do they really not want to do?
They don't want to lose money.
They don't want to lose money. Principal protection is critical, right?
Correct.
And so if you're going to invest into oil and gas on behalf of retail clients who, and this is where people can get chase tax strategies, right? That I mentioned, the tail wagging the dog can get, and people get blurry vision over the bigger picture. But if you're going to invest in this space, and you're wanting to manage downside protection, you have to have a specific strategy of how you do that. And so when we started Invito, part of the theory behind, there was multiple things we thought about why we started. Jared and I started the company. One was on the fee side. We felt like the fee side, there was a lot of misalignment in the space. And then on the second part of it, we felt there was just a misalignment of what retail clients would like and the assets that are being invested into. And so there are really a significant portion of the wells. So let me give you some stats. There's about 12,000 horizontal wells drilled every year in the United States. So, but what part of that is investable, right? There are large pieces of those, numbers of those wells that are in areas that have the potential to be either what we would call, people are familiar with, a dry hole, meaning it produces nothing, or it's an uneconomical well, meaning it produces, it can't pay out, can't cover its own expenses, and or it's a well that just is a poor performing well. Maybe it pays out, but it doesn't even reach a 1-to-1 payout, right? And so those are the wells you have to weed out. Now, every oil and gas company, and it's kind of broken into this categories of tier 1, tier 2, and tier 3 to make it very simple, kind of like class A, B, and C if people are familiar with real estate. C are tier 2 and tier 3 are what I would call kind of R&D. Tier 3 is the riskiest, tier 2 is the next riskiest, and then tier 1 is the most de-risked assets. And so as an oil and gas company, you are always allocating capital to tier 3 and tier 2, because if you don't, you'll eventually run out of tier 1. So new discoveries would be like tier 3, right? You're going into an area, nobody's drilled a well.
Yeah, my backyard.
Right? Which, not to get sidetracked, but another reason to be very bullish long-term on oil and gas, if you look at the number of new discoveries over the last 10 years and how much it's decreased, and then you look at the CapEx, how much it's decreased over the last 10 years, and you see no demand going down into the next 20 years, you don't have to be a genius to realize that is going to be, that's very bullish for long-term.
You don't need to have invested millions of dollars in December only for a war in Iran to pop off.
Right, exactly. So
it's going to go that direction with a war or no war.
Right. So my answer to that is you have the reason that happens is twofold. Either you got into a deal, maybe it was a decent asset, but the fee structure on the offering was so egregious that it was going to make it almost impossible to make money anyways.
Yeah.
And or it could be that the asset was just too risky. Maybe the fee structure was okay. Most of them, the fee structure and the asset, there's a massive misalignment of fees. The fees are way too high.
Yes.
Meaning your dollar is being discounted by 25, 15, 20, 25, 30%. Meaning you give them $1 and they take 30 cents.
Oh, absolutely. So when I first started looking into this, the first people I talked to claimed to me that they made all their money on the back end, that they weren't taking any fees up front. But when I got in the numbers, it was like 18% was coming off the top to somebody that had nothing to do with the deal.
Yeah.
And I was just like, I don't know if I was confused. I don't know if I was directly lied to. I was glad I didn't do anything with them. But it's really hard to make your money back when you're burning that much cash up front.
So that's true to all private placements, right? I mean, that's not specific to oil and gas. That could be I've seen lots of real estate deals that are just wildly over promoted up front. But if you take that over promote and you combine it with a risky asset, it's really easy to not make money or lose your money.
Gotcha.
You'll always never come out to be a zero, because you always get to make money out of the tax benefits, which is somewhere between conservatively 25, depending on what state you live in, because you can also offset state taxes in some cases.
Yeah, not in California.
Not in California anymore. Governor Newsom, through an executive order, killed that himself 2 summers ago. Not surprising, but you'll always make something off the tax returns. But if all you get is a tax benefit, and you make 30% or 35% off the tax savings, that's not a good investment.
No,
you should have paid your taxes and moved on down the line. So
exactly,
it's inherently understanding that oil and gas is a very high risk reward, high risk, high reward business, but how is the sponsor managing that risk? And so the second part I would say to that is, in oil and gas, for anybody that's listening, if you're ever looking at oil and gas deals, the other big red flag that I see a lot is people pitching just ridiculous returns on oil and gas. So you see someone and they're telling you you're going to make, 4, 5, 6, 7x, in 3 to 5 years. I'm just here to tell you that that's not going to happen.
Gotcha.
Right. Unless you get, unless oil prices stayed in the $90 or at least these levels for the entirety of the wells, and which is never going to happen.
No. You can just look at, you can just look at the oil charts. It's a pretty volatile chart.
Yeah. Well, commodities are extreme. They're one of the most, volatile assets out there, but it's an alternative investment. Right. And so I mentioned earlier that most alts don't have liquidity. So you need an illiquidity premium. So if I'm going to invest in oil and gas, well, if I can go, what can you put me into an S&P index fund? What am I going to get?
I legitimately, I have clients that have averaged 12% over the last decade.
Right.
In broken up among 3 ETFs that are tech heavy.
Okay. So if I'm going to invest in an illiquid asset, I should be getting something above that, some sort of alpha, right?
Yes.
Right. Now, of course, you can also include the tax benefits in that. You should, but I should get something above that. Otherwise, stick your money into an ETF.
Absolutely.
Here, just stick my money here.
Yeah. I mean, seriously, like if you just were in the SPY, the VGT, and the triple Q for the last decade.
Right. But what I'm saying though is You need alpha, but when
You do.
someone's trying to tell you that alpha is 2-3x what the index funds are,
Yeah. Not happening.
I mean, too good to be true.
Yeah.
That's
So what do you shoot for? What do you think is a reasonable, and obviously past performance is not indicative of future results and all the rest of the disclaimers and legal mumbo jumbo. But like what when you're as the CEO of an oil company who is entrusted with people's money to try and do like what do you think proper expectations are?
Yeah, I mean, I think we obviously pay attention to return on capital first. How long does that take? And then overall returns, we're looking to be in that 15 to 20% range. We think we're creating alpha if we can hit those metrics.
Gotcha.
Right now, that's a far cry from much of what we compete against that doesn't even get the payback.
Oh,
right?
absolutely. Yeah.
Right? You know,
Yeah. And then obviously, lining politicians' pockets to ensure wars in the Middle East continue. You've done a great. No, just kidding.
Yeah, right. Well, it's funny how many phone calls I've got. Is this good for us? I'm like, I mean, kind of hard to not be good for us. I mean, I don't feel good that there's a war going on, but that's not good for that's not good for the humanity side of things.
No. But in the words of Baron Rothschild, when there's blood in the streets, buy.
But these are the times you're glad that you have assets in the ground.
Yeah.
Right. And it's just like any other asset class, right? That's why it's an investment first. What is the proper, and this is where your role comes in, the advisor comes. What is the proper allocation based upon the risk profile of the client, the liquidity positions to invest, to allocate to an asset class like this? And then of course there are special circumstances, I would say, that maybe change that analysis a little bit, because obviously there is huge value in getting your money into a Roth. So a lot of advisors use us for that, right? There are the intrinsic additional benefits you are getting longer term by having your money out of a traditional IRA and into a Roth, so that you have tax-free income in retirement. That's, everybody should be trying to do that. I'm trying to do that.
And by the way, do you know you don't have to wait till you're 59 and a half? There is no 10% penalty on moving money from an IRA to a Roth.
Yeah, you can do that anytime you want, right?
Anytime you want.
Yeah, because all you just have to pay the tax.
You just have to pay the tax. So that is one thing that I thought would be really interesting, right? Is like you had a high income earner, maybe they get there by their 40s, right? You could literally, if they had the ability to, right? I don't know, a lot of 401ks trap the money and don't let it out and all that kind of stuff. But some have diversification rules that force the 401k plan to allow the plan participant to diversify out of the plan. And because you can always contribute more money to a 401k than you can to an IRA.
Right.
And so I thought, how cool would that be if somebody was really smart, max fund that 401k as much as you possibly can, and just every year roll it out, offset.
Yeah.
With a 50,000 or whatever, because you can roll this stuff forward, right? So you could even do $100,000 or a couple $100,000 in oil and gas, and just use that intangible drilling costs and bonus depreciation every year to move your money out of your 401k over to a Roth, or maybe your company offers you a 401k Roth. You put it into the 401k first, and inside their plan, roll it over to the Roth and offset the taxes on it.
Yeah, lots of strategy options.
Yeah.
Right? And just which reminds me back to the excess business loss rules, right? So if you go over those, right, it carries forward as an NOL.
For how long?
So you don't lose it. I think it carries over. I don't really answer that question. I don't know that there's a limit, but there is
I've not heard of a limit.
When you carry it forward, though, you can only use 80% of it. So let's say you had $100,000 carry forward.
Okay.
You would be able to take $80,000 next year, then you could take the additional 20 the next year.
Yeah.
So there is a little bit of but you don't lose it. It just gets carried forward.
Gotcha.
So just made me think of that when you said that. So but there's a lot of tax strategy planning that can be done when you have the ability to create a loss like this.
Oh, absolutely. Now, in regards to de-risking, when somebody invests their money into one of your funds, do you take all that money and go drill one well?
No, that would be concentration risk to the highest, right?
Yeah.
So no, you want to get, one of the ways to manage risk is the types of assets you invest into, meaning tier 1, tier 2, or tier 3. We focus on tier 1, which today is 95% of that acreage is owned by the top 50 E&P companies in the United States. And so that's why our fund is what's called a non-operated fund. We are invested into the wells that are being drilled by the larger E&P companies. An additional way you manage risk is underwriting the operator. We only want strong quality, strong balance sheet operators. And then, of course, get some diversification in terms of the number of wells, so that you don't have 2 wells in a fund. And, if something doesn't work as planned on one,
Yeah,
it's
you're
50%
screwed.
of your portfolio.
Now,
So-
because you're doing a non-operated fund, you're basically acting as the middleman.
We're essentially going out. Well, our job is we've got to go out. We're the ones that know how to go out and find the opportunities to buy this working interest in wells being drilled by the larger E&P companies. So we've got to find it. We got to underwrite it, make sure that it meets our performance metrics. We make sure it hits our risk profile. Then we got to acquire it, close it, and then then obviously we manage it inside of a fund.
And so that doesn't cause too many layers of people taking their fees off.
No, because we're the only fee in the middle. Just a fund. Yeah.
Okay.
Yeah.
All right,
Yeah.
cool.
There can be a when you acquire the working interest, depending on how you acquire it, there's a cost there, but you just have to include that in your underwriting.
Gotcha.
Right.
Gotcha. Yeah. All right. Do you do mostly horizontal, or do you do any vertical?
All horizontal wells.
All horizontal. Why?
Yeah. Every vertical project is what I would call, for to help people understand, what I call a statistical play. In other words, if this is the surface of the earth and you're drilling vertical wells,
And they're 10-inch pipes, right?
it just depends on how deep you're drilling, right?
Okay.
And what kind of a completion job you're doing. So let's just say I'm drilling a vertical well, and I got a well here, and 100 feet next to it, I have the same well. This well could produce 100,000 barrels of total oil. The next one over here can produce 20,000 barrels of oil. They're all statistical. They're just hard to avoid what's called statistical plays or statistical variances in
To
verticals.
translate that into my language, you're talking, it's a crapshoot.
There's just a
roll the dice.
There's a statistical variance on vertical wells.
Gotcha.
What horizontal wells did, the two things that changed the United States from the $3 million to $5 million day producer, the largest producer in the world, were horizontal drilling. That's the main one.
Gotcha.
And then the completion technologies, which people would be familiar with the term fracking.
Okay.
But how do you then get the hydrocarbons up out of the ground, right? What a horizontal well does is lowers that statistical variance. Because if here's a horizontal well going this way, let's say it's a 2-mile horizontal well, it's like drilling 40 vertical wells.
Yeah, because there's multiple openings along that pipe.
Right. So you may, along that horizontal well, right, well bore, you might get, it doesn't flow evenly. The hydrocarbons are not flowing evenly from each section.
Yeah.
Right. In other words, that 100,000 on that vertical well example, that
you got one opening.
That the section is going to be more productive than the one right next to it.
Yeah.
Now that I went 2 miles this way, I've essentially got like 40 vertical wells
off one drill,
off of one hole.
Yeah.
So that's one of the main things that has horizontal drilling has done. The fracking, what it did was allow basically oil and gas companies to go into areas where the hydrocarbons were there but were inaccessible because because the rock was too tight.
Yeah.
Right. And so two terms are called permeability and porosity. Essentially, when you frack rock, it creates the ability for the hydrocarbons to flow down, out, and come into the wellbore and come up and out.
Gotcha.
And so those two technologies, which the industry has just gotten better and better and more advanced and more advanced. The first horizontal well I drilled was a 1-mile lateral. They're now drilling 4-mile laterals, which is insane. I mean, if you think about it, the technology and the engineering involved in oil and gas, you're drilling a hole, sticking steel in the ground, coming down somewhere between 7,000 to 12,000 feet vertically, then bending the steel, right? Bending the steel and then pushing it out 4 miles. Unbelievable.
Yeah, no, it is.
It's unbelievable.
It is.
So the industry is just getting more efficient. That's why our production hasn't dropped, even though the rig count
is going down.
Has dropped significantly where it was, let's say, 10 years ago.
Gotcha.
Now there is a point of diminishing returns. I think we're reaching in there where
we're going to have to start putting more in.
Well, until this recent run up of prices, but if you get oil prices to hang for too long of a period, let's say in the 50s, the rig count will drop.
Yeah.
And then you'll eventually have a rebound up.
Gotcha.
A V-shaped rebound.
So you mentioned this is an illiquid investment. Mm-hmm. So what's the exit strategy?
For us, that exit strategy is, so most of these horizontal wells will produce for 20 to 30 years. But the way horizontal wells is, the production comes high in the early years and then declines over time. So for us as a fund manager, we don't want to manage a fund for 20 to 30 years, make distributions, file tax returns, produce K1s, that whole 9 yards. So once we get past year 5, because there is a thing called IDC recapture, which is similar to bonus depreciation recapture. In oil and gas, it diminishes significantly after year 5. We'll sell let's say the fund has got 15 wells in it and it's got X amount of production. There is a market to sell that cash flow to somebody else. And we'll test the market every year to see if we can get a good price and just do a final distribution and close the fund. And what we anticipate is that will happen somewhere between years 6 to 8, maximum by year 10. We want to be out of it. We just don't have any desire to continue to administer a fund beyond that.
Yeah. Awesome.
Yep.
All right, cool. I guess my last question for you is, so in 10 years when the world runs out of oil, what's our plan?
The world's not running out of oil in 10 years.
But they've been saying that since they found it.
Yeah,
I remember the first report, literally the year that they discovered oil, the government had a study and it said they're going to be out of it in 10 years. And it's like global warming. It's every 10 years, it's another 10 years.
Well, I think it was AOC that said the whole world was going to be over in 10 years, right? I think we only got a couple of years left on that call.
That's right.
Or Al Gore's calls.
Yeah. So
the doomsayers are always out there and have been forever.
Yeah. And so, one, you're confident there's plenty of oil.
Over what time frame are you talking about? I mean, forever?
No, let's just say for my client base, hopefully we're all dead here in the next 50 years. I really don't want to make it to 100.
Yeah.
50 years of oil?
50 years of oil for sure.
For sure?
Gas, yeah.
Okay.
I mean, to give you an example, the recovery rates for a well.
Explain a recovery rate.
So if I'm drilling down into the reservoir, which is where the oil is at, the recovery rates, meaning if there's whatever the total oil or hydro gas is down there, what percentage of that do we recover and actually pull out of the ground?
Okay.
It's gotten better, but it's like 15 to 20%.
No way. Serious?
Yeah, that's it. Right. And so there are all these strategies called secondary recovery strategies that are out there, tertiary, which are like another way to recover.
I learned that word in the Army.
Right. So there's all kinds of technology that's being worked on today. And so what if something gets changed in the strategies and the completion technologies, and all of a sudden that recovery rate goes to 30%?
Yeah. I mean, that's literally doubling the amount of oil that's accessible.
Right. I mean, I have a book from when I first got into the industry back in 2008 called Peak Oil, right?
Yeah.
Right. Well, this is before peak oil. This is before all of a sudden the United States in the next 10 years, 15 years.
So they were already saying we were at the peak.
We're already out. We're already running out. And the next thing you know, technology, and that's the beauty of the oil and gas industry in the United States. And why we're the leader is because most other countries, oil and gas are state-owned.
Yes.
Right. So what's the difference? Well, the
capitalism.
Capitalism. Entrepreneurship. Why is the United States coming up with all the technologies to find all these new ways to?
Yeah, because we're incentivized to do so.
Yeah, and they got all these guys that go out and take risk, put money to work, and find.
Yeah, I'd actually heard that we invented horizontal and fracking, and then for some reason gave it to the Arabs, and they used it for 10 to 15 years before we started. You ever heard anything like that?
I have not heard that because I don't think in the Middle East they're even doing it. They have all conventional production.
Well, and it's super easy. That was one of the wildest parts about being deployed over there in combat is the very first time it ever happened to me. It blew my mind. We're walking through the desert and there's literally oil, a pool of oil on the surface of the sand.
Yeah.
Like it was literally just oozing up out of the ground. And I was like, well, this wasn't hard to find.
Yeah. That's crazy, right?
Yeah. I don't know how much, I didn't drill a hole to find out how much was under there.
Right.
Build a fence and stake it as mine.
Yeah.
But
you wouldn't have lasted long.
No, definitely not.
Yeah. So no, I don't buy into, the bigger question is demand, right? I mean,
and that was the next thing I wanted to get to, right? People equate oil with gas in their car.
Transportation.
Transportation, right?
And it's about 60% of it.
Okay, so that's a good amount.
Yeah.
But like these headphones on your head, what are they made out of?
Yeah. Carpet
the
chair,
carpet,
medical equipment.
all
I
of
mean,
it,
oil is in everything,
literally everything.
right? And so just think about all the manufacturing as these third world countries begin to move up the manufacturing curve. They're going to just need more and more oil, right? So if you look long term, I just read like a Morningstar 2050 report, right? And they have demand continuing to grow
Of course.
through 2050.
Yeah.
Even with some of the sectors that use oil decreasing, and one of the ones they predict is on the transportation side, because they think there will be more electrification, right? And maybe there will, and maybe they won't. Nobody seems to have the answer though to where the heck are we going to get all this electricity if AI is going to need all this electricity that they say it's going to need. If AI is going to increase demand by 30%, well, where's that coming from?
Yeah.
Maybe we shouldn't have started sucking away all the electricity for cars. If that's what we needed all for technology.
Yep.
But we do have an abundant resource of natural gas in this country, that's for sure.
Yeah.
So again, in our lifetimes, and even beyond that, I'm not worried about it at all.
Yeah.
It's a great asset class to be invested into.
Absolutely.
Yeah.
So, all right. Well, anything else that we should have covered that we didn't?
No, I think
we did a phenomenal job
no,
personally, because I'm super
you do it.
self-centered, and I think I'm amazing, and I think you are too.
You did an awesome job, buddy.
All right. Well, I'm going to leave you. So now that all that's over with, I'm going to leave you all with, I'm going to go to what I said I wasn't going to go to in the beginning. I'm just really briefly. 2 books I would highly recommend. One is called Apocalypse Never by Michael Schellenberger.
Great book.
Phenomenal book. Okay. What I really liked about it, he very simply explained the energy, I don't know if you call it energy ratios or whatever, between things like wood, coal, oil, and whatnot.
Yeah.
And by the way, he is a lifelong raging left-wing Democrat.
Yeah.
Okay. And phenomenal book. Insanely, I think the book's 750 pages, and 250 pages of it are sources.
Yeah.
like it's probably the most heavily sourced book I've ever read.
Yeah.
And then the other book I would highly recommend is called The Moral Case for Fossil Fuel. Have you ever read that?
Who wrote that?
I'd have to go grab my copy of it.
Yeah, I don't know.
But it's who wrote?
An interesting stat I always give people is you've got 2 billion people on this planet, 2 billion, who still cook with wood and dung.
Wow.
Right? About 1 million people to 1.5 million people every year die.
Alex Epstein, published in 2014.
Okay, so I was going to say, is that Alex's book?
Yes.
And so I am a part of Alex's group called Energy Talking Points.
Oh, sweet.
So, and he's having his annual conference here in a couple of weeks. So Alex is great. You can follow him on social media, follow him on LinkedIn. He does a great job of providing data. And of course, Chris Wright, who's the current energy secretary, CEO of Liberty Energy, he's been a guy that out there has been, making that case for a long time. Does a great job. Really smart guy. But you got 2 billion people cooking with wood and dung. Can you imagine that?
That's horrible.
About 1.5 million people die from particulate matter every year, meaning because they're living in a small little house that's using wood or dung to cook, and all of that particulate matter just stays in the house.
Yeah. And so one thing I'd always tell people, right? Is just be careful either way with extreme statements. And I'm just going to end on this. Okay. John Holdren is talked about quite a bit in that book. He was Obama's top science advisor, director of the White House Office of Science and Technology Policy. Okay. He said it's possible that the carbon dioxide climate-induced famines would kill as many as 1 billion people before the year 2020. Okay. And he was literally the science advisor to President Obama.
Yeah.
All right. Instead of that catastrophe materializing, famines plummeted, climate-related deaths across the board down 50% since the 80s and 98% since major CO2 increases began. And what's even more insane to me is when you get to their quotes just about their view of humanity.
Right.
their opinions are very much dictated by these biases that humanity is a disease upon the earth. And they have some of the most insane quotes you could ever possibly imagine. And unless I pulled them up and played you video of them saying it, you would not even believe me.
It's kind of scary.
It's terrifying. Another great one was in the book talked about is where they're asked, what about nuclear energy? What if we were able to create cold fusion? And their view is that is bad because that energy would allow proliferation of humanity across the globe.
Which is just,
right. And so when you hear people speaking negatively about energy, right, these top thinkers that are appointed to these political positions, if their view of humanity is that we're a disease, you should probably really question everything else that's coming out of their mouth.
Yeah, it's crazy thought, right?
As far my opinion is, the two greatest things that ever happened to humanity are literacy and oil.
Well, the advancement of humanity, the development of humanity is, if you discover the discovery of fire, the wheel, and then hydrocarbons is probably the next one.
Right.
In terms of the improvement of life, life existence, and longevity.
Oh, it's just incredible.
Right? I mean, think about it, before fire, before the wheel.
Yeah.
And, but what were we burning for oil, before we found hydrocarbons? I mean, we basically saved the whales because they were burning whale blubber for to light homes.
Yeah. I mean, if it wasn't for Spock going back in time and rescuing one of them.
Yeah. So you could go on that one could go on that one, but you're right. The extremes are, I mean, look, when you have a politician tells you that the world's going to be over in 10 years, it's like, you can't actually believe that.
No.
Do you really believe that?
Yeah.
I mean, maybe they do, or it's just for all political power. Yeah. Which is my assumption.
My assumption is always they're lying to you.
Yeah.
And then just try to figure out how.
Yeah.
And you're going to probably be in a pretty good spot.
Yeah.
So anyways, I hope you guys found this informative. I know we covered a lot, but I thought we did it in a pretty good orderly way. Yeah. We have a pretty amazing oil and gas program for all of our clients. I think we did 4.8 million in December.
Yeah, last year. I don't know if it was all December, but throughout 2025 was about that in total. Yeah.
Yeah. And that's 4.8 million in income, untaxed, essentially ish. Right?
Yeah, we didn't even get to the tax benefits on the income that comes to it.
Well, yeah. Okay. Quick. Let's sorry. Hope you're still watching. All right. So when they start getting income from it, that income comes in two tax forms, correct? 85% is fully taxable.
Yeah.
Right.
So essentially the easiest way to see it is that it's a tax efficient income stream as well. So this is a passive income generator, mailbox money, you want to call it, right? Mm-hmm. You just start getting deposits in your ACH deposits every quarter. And the income is tax efficient in that you only pay tax on it 85% of that, or another way to say it, 15% of it's tax free.
Yeah.
And that's another part of the code that was used to incentivize capital to flow this direction. So it's a tax benefit on the front side, and then it has a tax efficient flow of income to you as well. So forgot about that. Sorry. That's called the depletion allowance or the small producer's tax exemption.
All right.
And every investor will qualify as a small producer.
Sweet.
Yeah.
Well, there you have it, everybody.
So, good way to end it.
Great way.
Yeah.
Until the next educational video, this is Elliot and
Steve Blackwell
from
Invito Energy Partners.
Yep. And if you want to skip us and go straight to them, how do they get a hold of you?
Just go to Invito, invito.com, and you can get a hold of us there.
That's right. And I'd highly recommend that. And you're going to be on another podcast this afternoon with me.
Backseat Ballers.
Backseat Ballers, baby.
That's right.
So that is going to be a very different. We're not going to talk about any of this.
I don't know what we're going to talk about. You won't tell me.
We're going to talk about the man, the myth, and the legend that is Steve Blackwell.
Oh, boy. You might want to skip that one.
All right. Everybody, take care. See ya.
Take care. See ya.